To begin, welcome to our deep dive on whether you should invest, save in a 529, or crush debt first. This video is designed for young professionals earning high incomes while carrying moderate to significant debt. We will compare guaranteed returns from debt payoff, the unique window of Roth IRA eligibility, and the controversial but potentially powerful 529 strategy. Along the way, we will use diagrams, examples, and quizzes, and we will end with a practical action plan. Next, here is our roadmap. We will first clarify the dilemma and set a decision framework. Then we will tackle the debt imperative and when high interest rates demand aggressive payoff. After that, we will discuss the Roth IRA window and why timing matters. Then we will decode the 529 strategy, including rollovers and state tax incentives. Moving forward, we will present an order of operations and several visual decision maps. We will also include a couple of short quizzes. Finally, we will summarize and provide next steps. Before we proceed, a brief disclaimer. This video is for educational purposes only and does not constitute financial, tax, or legal advice. Your situation is unique, and you should consult a fiduciary financial advisor or a certified public accountant before implementing any strategy. To set the stage, the typical scenario is a young professional earning a high income with moderate to significant debt, often $60,000 or more. You want to balance tax optimization, liquidity, and long-term growth. You are likely comparing three paths: investing in the market, contributing to a 529 plan, or accelerating debt payoff. Additionally, you may soon phase out of eligibility for direct Roth IRA contributions due to income, which creates urgency. Now, let us address the debt imperative. When your loan interest exceeds approximately 5%, accelerating payoff is often the most financially sound move. Paying down a 6.5% loan is essentially a risk-free 6.5% return. That is very difficult to beat consistently with investments on a risk-adjusted basis. Focus extra cash on the highest rate loans first, particularly higher rate student loans and personal loans. While you keep paying the minimums on low-rate debt, direct surplus funds to the highest rate balances. The benefits include a guaranteed return, a simpler risk profile, and notable psychological relief. Reassess periodically as balances fall and rates change. Meanwhile, this table compares the three paths. Crushing high-rate debt provides a return equal to the interest rate with very low risk and strong psychological benefits, though it offers no direct tax benefit. Investing in a taxable account offers higher liquidity and preferential tax treatment on gains and dividends, but comes with market volatility. A Roth IRA offers market-driven returns with the powerful advantage of tax-free growth and potentially accessible contributions. A 529 plan also offers market-driven returns with potential state tax benefits, but has more limited flexibility since it is education-focused, though recent rule changes add some optionality. Next, this flowchart visualizes the decision-making framework. It begins by assessing loan interest rates. If any loan exceeds 5%, you prioritize extra payments there. In parallel, it checks for an employer retirement match, because leaving a match on the table is effectively giving up guaranteed returns. After ensuring high-interest debt is addressed and any employer match is captured, the decision path tests Roth IRA eligibility and encourages maximizing the current year contribution due to income phase-out risk. Only after addressing these priorities does the flowchart consider a 529, and only when there is a genuine education goal and favorable state tax incentives. If those conditions are not met, the framework points to a standard taxable investment account. The diagram also includes a feedback loop to reassess when interest rates, balances, or income change. After debt triage, let us highlight the Roth IRA window. In 2024, the contribution limit for those under 50 is $7,000. High earners can quickly lose direct eligibility due to income limits, so it is wise to contribute while you still can. The main benefit is tax-free growth and tax-free qualified withdrawals in retirement, which can be extremely valuable. A secondary benefit is some flexibility, since contributions are generally accessible without penalty, though earnings are not. If you are phased out of direct contributions, consider whether a backdoor Roth IRA is appropriate, and ensure strict compliance with tax rules. Furthermore, the 529 plan can be useful when there is a genuine education goal. Under recent changes, certain conditions allow a limited rollover from a 529 to a Roth IRA. The lifetime limit is $35,000, The 529 must have been open for at least 15 years. The beneficiary must have earned income, and yearly Roth contribution limits still apply. Additionally, up to $10,000 can be used to pay qualified student loans for the beneficiary or their siblings. Some states offer deductions or credits for contributions, but the net value depends on your tax bracket and the state cap. Be mindful of plan fees, investment choices, and the reduced flexibility compared to a taxable brokerage account. In contrast, this comparison balances state benefits against flexibility. On the left, a 529 may offer immediate state tax deductions or credits, it is purpose-built for education, and it has potential for limited rollovers to a Roth IRA. On the right, the trade-offs include restricted use with taxes and penalties for non-qualified withdrawals, potential plan fees with limited investment menus, and the possibility that the state benefit is modest compared to your income and priorities. Now, this pie chart demonstrates a hypothetical allocation of surplus cash when high-interest debt is present. 40% goes to extra payments on loans above 5%. 20% goes toward capturing any employer retirement match and critical pre-tax minimums. Another 20% is directed to the Roth IRA while eligibility is intact. 10% tops up an emergency fund to strengthen resilience. The remaining 10% is split between a small 529 contribution if there is a real education goal, or a taxable brokerage account if flexibility is the priority. This is just an example and should be customized to your cash flow and goals. Subsequently, here is a practical order of operations. First, list all debts with their interest rates and balances. Second, pay all minimums and direct extra cash to loans above 5% APR. Third, capture any available employer match because it represents an immediate return. Fourth, build or maintain a 3 to 6 month emergency fund. Fifth, maximize the Roth IRA while you remain eligible and evaluate a backdoor Roth if phased out. Sixth, consider a 529 only when there is a clear education objective and meaningful state benefits. Seventh, invest remaining funds in a taxable account for flexibility and rebalance annually. Then, this timeline outlines a potential first 24 months. In months 0 through 3, list debts, automate minimums, and begin extra payments toward loans above 5%. In months 4 through 6, ensure you capture any employer match and build the emergency fund toward 1 month of expenses. In months 7 through 12, aim to maximize the Roth IRA contribution while continuing debt acceleration. In months 13 through 18, reassess interest rates and only then consider a small 529 contribution if there is an education goal and meaningful state benefits. In months 19 through 24, finish paying off high-rate debts, increase taxable investing, and set an annual review cadence. Next, here is a quick quiz. The question is, you have a 6.5% student loan, eligibility for a Roth IRA this year, and no employer match. What should be prioritized for surplus cash? The options are A. Open a 529 and contribute first. B. Invest in taxable for flexibility. C. Accelerate payments on the 6.5% loan while also aiming to max the Roth this year. Or D. Only invest in crypto. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. Now, the correct answer is C. Accelerating payments on a 6.5% loan delivers a guaranteed return equal to the rate, while also attempting to maximize the Roth IRA during your eligibility window secures tax-free growth. If cash flow does not allow both, prioritize the high-rate loan, then contribute to the Roth as much as feasible. Next, let us test your knowledge on 529 rollovers. Which statement is true? A. Any amount can be rolled over at once with no limits. B. The 529 must be at least 15 years old. There is a $35,000 lifetime rollover cap, and annual IRA limits still apply. C. You can roll over even if the beneficiary has no earned income. Or D. Rollovers do not count toward annual IRA contribution limits. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. Now, the correct answer is B. The 529 must be at least 15 years old. There is a $35,000 lifetime rollover cap, and annual IRA contribution limits still apply. Additionally, the beneficiary must have earned income in the rollover year for the contribution to be permissible. Before we wrap up, here are the key takeaways. First, When debt exceeds 5% APR, prioritize extra payments because the return is guaranteed. Second, treat the Roth IRA window as time-sensitive and contribute while you are eligible. Third, use a 529 primarily when you have a clear education objective and meaningful state tax benefits. Fourth, if available, always capture an employer match. Fifth, reassess your plan annually as rates, income, and life goals change. Finally, in summary, identify all debts and focus extra payments on those above 5% APR. Capture any employer match. Maximize the Roth IRA while you still qualify. Consider a 529 only when education goals are clear and state benefits are meaningful. Invest the remaining surplus in a taxable account and schedule an annual plan review. As a closing note, thank you for watching. If this video helped you clarify your plan, please like the video, share it with a friend, and subscribe for more smart money content. Tell us in the comments whether you plan to prioritize investing, funding a 529, or sprinting toward debt freedom, and why.